Cool. So kind of talk through the theory and the main differences between risk entries and confirmation entries, and kind of ideally when to take risk entries, and then how you can look at the, the refined lower time frame POIs within there to set your risk entry on. Let's take a look at an actual example. So using sort of the 3 time frame philosophy, we're going to look at someone who would be an M15 trader. So someone who wants to enter on the M15. So daily chart is our higher time frame. What phase are we in? That's the question you ask yourself. Are we in the pro trend run phase, or are we in the counter trend pullback phase? Well, hopefully we can see as of right here, we are in the counter trend pullback phase. Okay. So daily structure is clearly bullish. Swept liquidity, as we know, that's just how a strong low forms. Strong momentum to the upside. That becomes our strong swing low. And we can see that it was a sweep flip, right? That we flipped that level there. So pretty decent POI to potentially look for price to continue. But in terms of, actually looking for a trade right now, we're not looking to get long. We're looking to potentially keep shorting down into this demand, right? Until we then get that shift in structure to then look at that, potentially if that higher low is going to continue. So right now we're looking, we're playing that pullback phase down into our higher time frame demand. Okay. So now we want to look at our medium time frame, which is our sort of main time frame for our immediate bias and our POIs and our ideas. So for our chart, we can see we had that big, strong reaction, right? We swept all of that buy side liquidity, big move to the downside as the 4-hour chart shifted bearish. So if the daily is bullish and the 4-hour is bearish, why did the 4-hour chart likely switch bearish? It likely switched bearish to do what? To facilitate the daily swing pullback. So what that tells us is it's not a guarantee, but it's likely that the 4-hour trend is only going to stay bearish until it mitigates this daily demand zone, right? And then there's a decent potential, again, not a guarantee, a decent potential that the 4-hour trend may then switch bullish. Why? Because it's done its job. It has fulfilled its objective, which was what? Which was to facilitate that daily pullback. So if we mitigate daily demand, maybe the refined 4-hour demand within here, and then the 4-hour switch is bullish, that's a pretty good signal that the daily swing pullback may now be over, right? And then we can follow that movement to the upside, okay? So keeping it more relevant to looking for an immediate trade idea, 4-hour chart is bearish. That's the direction in which we ideally want to be trading from within. We can see that we pulled back up. Now supply did fail here. It wasn't respected, but as you can see, it was a big sweep of external range liquidity, right? The liquidity behind the 4-hour swing high. You can see the aggressive nature in which we've retraced back down into the movement. So this low has failed to cause a candle body break of the high. So there's pretty good reason to believe that this low is still weak. And we can look for that low to get run. And remember, daily chart hasn't yet reached that daily demand, okay? So shorts are counter the daily swing trend, but there's loads of calls for lower prices, right? We can expect price to potentially come lower into that daily demand before potentially the 4-hour chart may switch bullish. So like I said, 4-hour chart bearish, swept the external range liquidity, and then since then, big sweep to the downside, and we can see that bearish order flow. So we can see here, right, we had a break of that fractal low. We came back into that 4-hour supply that caused a break of that fractal low, and then another strong movement to the downside. Now, this 4-hour POI, is it the best 4-hour POI in the world? No, it didn't sweep any liquidity. It doesn't have any inducement. It hasn't even really broken the structure. It's just kind of in the leg. But because how aligned everything is, heavily bearish, we haven't mitigated any significant demand just yet. We've had a big sweep, so it's very likely this pullback is now over, and now we're ready to target this low. And also, we're obviously reacting off this little bit of demand in here, but this is at a weak leg, right? A weak low. So we just expect it to be a reaction back into supply, the nearest level of supply, right? To then continue. So this reaction does what? It generates sell side liquidity, right? It induces market participants to transact at this level on those equal lows to generate the sell side liquidity here. So now if price comes into supply, we can look for that continuation with that liquidity to target, okay? So on paper, maybe it doesn't sound like the best 4-hour POI in the world. Like I said, doesn't sweep, doesn't have inducement, but it's because of the higher time frame story, the 4-hour story here, right? We have room to target down to daily demand. The 4-hour chart is bearish. We've swept external range liquidity. We're coming down with a ton of momentum. So everything's pointing towards this low being run. We have this supply chain to follow, so we can potentially look to short from within here, right, to target those lows down here. So that's the POI we want to trade. Let's look to the M15 for our potential entries. So like I was saying, for pretty much the majority of the course so far, we've just been concentrating on what we call confirmation entries, okay? So waiting for price to come into our medium time frame POI. So in this case, it would be our 4-hour POI. Once our alert goes off, once price reaches it, we can then look for our lower time frame confirmation entry. So in this case, it would be the M15, and we can look for the CE or the DCE. So I'm going to talk through that, and I'm going to also talk about how we could potentially take a risk entry on our medium time frame POI too. Okay, so if I go back to the 4-hour chart, the most unrefined way to do it would be to just enter a limit on your medium time frame POI. Now, if you're going to do that, I wouldn't really recommend you do it in this case because, like I said, on paper, it's not the best 4-hour POI in the world. Risk to reward is, you've got like a 1-to-1 almost to the low. Daily demand's just here. It's not great. So this is where you definitely want to be refining this on a lower time frame if you're going to take a risk entry in this instance. So we jump down to the M15. You can see here again, you're not going to overanalyze structure if it's your lower time frame execution time frame, but we can see that's the M15 swing structure. Just like it's the same as the 4-hour chart in this instance, we swept the high, big movement to the downside, and you can just see the sustained bearish order flow, right? So if we look within our 4-hour POI, where are there potential refined lower time frame POIs within here? Well, we've got always basically where I'll start from is the extreme, okay? The extreme of this leg within the 4-hour POI, because that's going to be generally the highest probability, because if this POI up here fails, right, if we come up and break that high, well then, the POI is failed, so we're probably going up higher. So the extreme is where I'll always start with, because ideally that's where I want to be shorting from. However, we can see here what happened when that POI was created. We had a pretty deep, movement back into it, filling up those orders. I would say that's a pretty, deep mitigation. It's the EQ of the zone, and then we've moved away. We've come in again, and we've moved away. So I would say there's a pretty decent chance that zone's already been used. And then if you could look at those next orders, right, those buy to sell wicks, because that's where the pullback came in, that's then had an initiation out, a pullback into it, mitigation, and then another initiation out. So then again, that gives me confidence that the majority of those orders have been filled, right? It's not like we've kind of just trickled down and gone out. We've actually had a clear movement back in and a clear movement away. So this is a very good example of when then you have this. So if I just go back to here, and then we look at the refinements, this would be a good example of this. Obviously, you're going to have to flip it upside down in your mind, or maybe I can do that for you if I do Alt and I. Here, right? There we go. Look at that magic. Whereby so the big grey box is our 4-hour zone, right? And now we're dropping down to the M15, our lower time frame, to look at potential refined levels. Well, we had the extreme mitigated, then we kind of had the next one on from that mitigated, and excuse me, you can see how it was a flip that swept liquidity, and we pushed down. So that would be basically what we would refine or call the unmitigated extreme. Okay, so we had the extreme here as mitigated. All right, we had initiation out and another mitigation there. So we're seeing that supply chain form. This isn't a clear-cut flip, because technically you could argue the edge of this one had already mitigated, but you can clearly see, right, there was demand here, prices come in, reacted, and pushed down, okay? It's a bit of a subtle sweep, but you see how you have that inside bar? So what is that? It's a range on a lower time frame, so we have that fractal pullback. So there is a sweep of liquidity there just about. So I prefer it as a little bit more obvious, but I would count that as a flip that swept liquidity. And then bonus, we also have that structural high there, potentially acting as inducement for our POI. So this ticks pretty much every box. So like I said, for the most part, if I want to be taking a refined risk entry, I usually want to be doing it on the extreme, because I want to have my stop loss covered behind the high, right? So we come in, if I get stopped out, well then the trade idea is wrong, right? Because the POI has failed. Whereas if you've got multiple POIs, you could take multiple hits trying to trade all of them. So generally I like to enter on the extreme, but this is a great example of where I have a lot more confidence taking a risk entry, within kind of in the middle of the zone, because you've built the story here, right? You've got, like I said, demand chain, flip that sweeps liquidity, and it has inducement. But for the most part, I want to see that chain, that previous mitigation, and a flip that sweeps liquidity. So this is a very good example of where you can set your refined risk entry if, and a big if this is going to be within your trade plan, okay? You don't have to trade these. Of course, you can just use these as additional confluence to then look for our standard, entry models, depending on what you want to use, okay? So then another POI, next one along, because of course price doesn't have to come back to that POI, we have this level here. Is this a decent POI? Well, it led to break of structure. It's well priced. It's within the POI. So yeah, definitely could. But we don't have any nearby inducement. We've got this high here. So potentially that could work, but it's pretty far away, right? We've got nothing in that immediate leg. And I would count that as the actual true flip, part of the previous mitigation. So, if you've got an unmitigated extreme behind, that's the one I want to take. And that's kind of what I was trying to say here is generally, if you're going to take a risk entry and there's multiple POIs, you want to ask yourself, where's the highest one or the best price one? Where is the unmitigated extreme? And like you've got two here, this is going to be that one, okay? So if you're going to, me personally, I wouldn't recommend setting multiple risk entries. Just try and take one if you're going to take it, okay? And play a confirmation entry off the other. So, i.e., leave your risk entry here, and if price comes into this, and then gives our entry model off here, well then yeah, let's get involved. And you can leave your risk entry on here in case we start to trade away. Then of course you can cancel. But yeah, okay. So let's set our risk entry on there, and then let's look for our liquidity entry models on here, because remember on the 4-hour POI, what don't we have? We don't have any lid, right? We don't have any leg inducement here. So we need to see our lower time frame strong liquidity entry model built to the right on the pullback. So let's play price forward and see how we get on, okay? So we come into this POI. This isn't the one that we want to set a risk entry on because we're above. So let's see if we can trade a confirmation entry from here, but I want to see strong liquidity get taken. Because yes, we've got inducement here, potentially to the left, right? So if we know if this inducement is being used, what do we need to see? We need to see the PBL fail. Where is the PBL? Well, let's just take the nearest one and be super, super aggressive, right? That's the nearest one we've got there. I have to zoom in to drag this across. You would want to see that fail, right? At the very least, or maybe even ideally here. That hasn't happened and we pushed up. So now I want to see up here at least a strong, I need to see some strong liquidity taken. This high does not count. Why? Because that high is not a strong high. It hasn't achieved anything. It hasn't broken any structure. Okay, so nothing to do. Let's just be patient. Okay, now what do we have? Now we have a break of that low, right? We've got an M15 chock. So what does that do? That now can entice market participants to transact at this level to generate available strong liquidity behind this high, right? So then you can mark that out as your strong liquidity line, okay? So this is then the high that we can wait to go to see if we can get that strong liquidation, okay? So now price has traded up higher and we've been tagged into our risk entry, okay? Happy days. So now we can see that this POI has clearly become inducement for the one above. So never a good one in the first place. We didn't take any losses because we waited for that strong liquidation to occur. And now even better for our risk entry, right? We built that strong liquidity for our risk entry here. So it can give you even more confidence to either set this risk entry when this starts to build here or, leave it on, for whatever reason, if we're having doubts about keeping it on, right? So this is perfect. Hopefully you can see all of the concepts starting to come together, right? 4-hour POI, we found the unmitigated extreme, with a refined level. It's the sweep flip. Demand chain, it had inducement there, which is just, it's a little added bonus for taking refined risk entries. We came back into our POI, we let the fake break happen, we've got the strong liquidation into our risk entry, okay, happy days. Now let's look for a potential confirmation entry, right? And see what occurs. So we've had the strong liquidation. Where is the point before the liquidation? Where is the PBL? We have this demand here, right? So we would need to see that fail. And what also would we need? We would need to see our change of character down here, okay? So let's move this forward, okay? And now we've got that. So we've got the strong liquidation into our hard time frame mitigation. We have a PBL has now failed and we've got the chock, okay? So I'm just gonna move this to the side just for a second, just so we can see price action so it's nice and clear, okay? Where is the entry? Well, do we have the extreme? Yes, but it's being mitigated, right? We can see we've already had that mitigation and we also have a flip, okay? So you can see price has come into demand, it's reacted, mitigated the extreme and pushed down. So nice and simple. You've only got one POI to choose from for your entry. And then you can take your confirmation tree. So I'm just gonna move the risk entry back in and then you've got this level here, okay? And there is your CE. So we can target the nearby low, or obviously we've got those 4 hour and M15 swing lows down here, right, where you can target that sell side liquidity. So you've got 4.3R and a 10.39R there. And again, in the next lesson after this, I'm going to talk how you can refine that even further. But let's see. So we get pulled in, drops around, and then we go boom, and then you can try to break even if you use that method, okay? So now you're in 2 good trades. So if you wanted to take the double confirmation entry, this is where then you can look to enter in here, okay? So again, I'm just gonna move these to the side for a second, just so we can concentrate on price action. And the DC is somewhat simple. You're just looking for price to come in for your CE, then we get another break, and then you're basically trying to follow the chain, and then you look for price to come in. What's nice about this is you have a flip that swept liquidity, okay? Because you've got the sweep of that high there. Now this demand in here, it's not technically strong demand, it didn't break any structure, but when you've got this sort of entry model, right, where you've got the confirmation entry, you've been tagged in, and then price comes in like this, reacts, sweeps liquidity, and pushes down, that's the sort of thing exactly what I want to see for looking to kind of continue and follow that order flow, right? So this is where then I would consider setting an entry order, right, if you're trading in 15 for a DC. So I'm just going to move these back into position. There was our confirmation entry. See how it gets a little bit messy. And then this would be your DCE, okay? And then you can have the same target. So space forward, and then in the end, we hit those lows, okay? So at that point, I wouldn't leave my entry order on, and the DCE didn't get tagged in, okay? But that's essentially the crux of it. Risk entry, you're entering within your medium time frame POI. We refined it to the unmitigated extreme. Talked through that loads of times, so I won't bore you with going over that again. Then we waited for our lower time frame entry model, right? We got the fake break, strong liquidation, mitigated the extreme. Then you got the flip, so we can only enter on 1 POI, nice and simple. And then we got, basically another M15 boss, right? That lower time frame continuation. And then you just look to follow that train, but we never got the entry, but that would have been your DCE there. And it was just nice that we have that flip, right? The demand reaction sweeps liquidity and pushes down, and that would have been that level there. So hopefully you can see now, if I flip these back around, that's essentially what these would be. The DCE just didn't happen in this case, okay? And that'd be from an M15 trader's perspective. Now that whole thing can just be applied to, if you want to enter on the M5 or M1, it's all the same thing. Like at the time of recording, M1 entries is the main way in which I trade, and I view all of that the exact same way. It's just that when price comes into these blue boxes, those blue boxes are my medium time frame. So when price enters them, I'm then doing what we just spoke about, but on the M1. So it's just the fractal nature of it. So i.e. when price comes into here, I can then drop down to the M1 and I can look for the risk entry, confirmation entry, and a double confirmation entry when we hit this blue zone. So if I was going to take a risk entry, if I'm an M1 trader, right, I want to be entering on this zone directly, but I could refine it to an M1 zone within there, and then also then look for what? Look for our lower time frame entry models. It's the exact same thing. So let's go and take a quick look at that. So this is that M15 POI that we took the M15 risk entry on. But then within that, what can we do? Look, if you're an M1 trader, what do we have? There's only one real, it's the extremes that makes it nice and easy for you in this case. What do we also have here? We have a sweep of liquidity, okay, at the extreme, and it's a flip, okay, because we've got this level of demand. So we can see price came into demand, reacted, failed to put in a higher high, swept all of that liquidity. We've even got like an internal sweep within there and a nice strong movement down, okay, refined extreme within there. And that would be a very, very tidy M1 refined risk entry. And you can just see now how you start to get really, really powerful risk to reward on these sorts of trades, right? So, 2.5, 3 pip stop sort of thing. That's the kind of territory you're in. And if you've built the high time frame picture correctly, which we have in this instance, and if you have the high psychology to do this, I personally don't. I'm terrible at this, but you could, there's logical, technical reasons with the framework that we follow to target these lows. So you can see that over 20R. Now, I'm not a big proponent of this, trying to swing for these big trades all the time. I think there are better ways in which to reach consistency, and you need to find a trading style that you can execute at scale. And what I mean by that is if you have a $1 million account, a $5 million account, a $10 million account, that are sorts of goals you want to have for your long-term career, right? Managing that big amount of capital. Are you really going to be running 10, 15R and then hold up, we could have come up higher. We always could. So I don't want to rant about that now because it's beyond the scope of this lesson, but just something to think about, okay? But in terms of, me being an M1 trader, I get this question a lot. It's like, when are you going to take risk entries? Well, these are the types. It's basically where I think of myself as if I was an M15 trader, where would I set that risk entry? Where would I have high conviction in entering? And if, this is it, right? Basically, this is your M15 internal range. That's your strong M15 high. This is your M15 extreme, flip that formed through a sweep liquidity. You got inducement in the leg. You've had a strong liquidation built in front of your POI, right? It's nested within the 4-hour POI. Everything's aligned to target these lows. Coming into London session open, like that is the time in which I take a risk entry. Now, the next time in which I think is even better to take a risk entry in terms of the M1 or whatever time frame, it's all the same thing, is when your medium time frame then does all of this, right? We get the medium time frame strong liquidation into here, then it shifts bearish. Okay, so you've got this structure shifting bearish, right? Facilitating that larger pullback into here. Then it shifts bearish, confirming the end of this pullback. Everything is now aligned. This becomes your strong M15 small internal high. Then we pull back into here, right? Again, risk entry territory, because this is your M15 unmitigated extreme, right? This is already all mitigated. In here is then when, that's where you want to set risk M1, set an M1 risk entry. It's hard to get all these words out, geez. Because everything's aligned, right? That's the place in which we expect it to continue. You've now waited for things to shift, right? That's a bit risky to take that risk entry because, technically order flow is bullish at that point. And then you get the movement, you've got the liquidation, you've got the flip that's taken down here. Now you've got everything aligned. That's when you can look to take a risk entry and go in there again, okay? So that wasn't that initial risk entry that we spoke about here on the M1. And then likewise, if we had got our M1 entry within here, we didn't. But if we had got there, then I would have looked for the CE and then the DCE, and then we can catch it up here, but it didn't set up around here. Then we got the M15 alignment, giving us our new M15 zone. So this is where we said before, right? If you're an M15 trader, where you're entering on this POI directly. If you're an M1 trader, or even if it's M15, you still might want to refine your M15 risk entries to the M1. What do we have? We have the extreme, okay? There's no clear flip that swept liquidity or anything like we had before. So this is where you just enter here, right? And then you're in a beautiful trade, all aligned. And again, you can target that low for so much logic behind this. These are the types of trades. Now, this type of price action does not occur every single day, right? But when it does, it becomes, you'll see it. I've seen it with the guys and girls who have been in for a while, and they see it and they know these are the environments to take advantage of it. Not when we're just kind of range bound on the M15 and the 4-hour chart, whatever time frames you use, and there's no real clear intention. This is when the 4 hours align, the M15's align, we pulled up to a great area, loads of risk reward. You've looked for your liquidations, you looked for your confirmation. Now you want to get involved. There's your risk entry, okay? Appreciate it looks a little bit confusing when you've got all these boxes on, right? But essentially, hopefully you guys can see that, right? That's your M15 shift in structure. That becomes your new M15 range. We can see that M15 POI was mitigated. This becomes the new M15 POI. It's the only one we want to trade from, and you just refined it to the M1 extreme within there, right? And you can see, what did that M1 extreme do? It swept liquidity, okay? So that becomes basically the high that you want to trade from. And of course, you can look for your lower time frame entry models from within here as well. But it's all about the medium time frame, depending on which one that is for you, depending on what you're looking at. Okay, but yeah, so I've gone over the same piece of price action from two different lenses. Whether you're an M15 entry trader, right? We looked at the M15 risk entry, okay, that you could set from the moment price is down here. If you're an M15 trader, you can set that order because that's your refined lower time frame POI within your higher time frame POI, right? And it's the chain, sub liquidity, has inducement, etc. If you weren't sure about setting this risk entry here, but then you see this develop where you see now strong available liquidity built in front of your POI, now you've got even more confidence to set it. Okay, so then you take the risk entry, then you get the PBL fail, right, that caused the strong liquidation, and then you enter on the flip. So there's your M15 confirmation entry, and then the DC didn't set up. Now, if you're an M1 trader, right, the M15 is your medium time frame. This is your larger strong internal high. Here we go, M15 strong, okay. This is your week low. And what's happened? Price has small internal structures shifted bullish to facilitate the pullback into the extreme. You can look for your risk entry from within here and then look for your lower time frame entry models. Then it shifts bearish, confirming the end of this larger internal pullback. This high now becomes your strong internal high because it's broken the low, right? Your small internal structure within the larger internal structure. And then this becomes, again, another high probability entry to look short. And you can take your M1 risk entry from within the refined M15 level. And then you can look for your lower time frame M1 CE and DC as well, and then target these lows. And then it's just beautiful price action, right? And that's exactly how we're doing it. And they're the differences between it. So hopefully now you've kind of got an idea of sort of the differences between them and when to look to take risk entries, and then basically how you can look to sort of mechanically know what POI to take if you want to take a refined entry within there.